Well, it looks like the stock market crash of 2022 is now back in play. This is because of Snapchat earnings, but not specifically just Snapchat. Take a look at Facebook, down over 5%. Google, down over 3%. What's the connection between these two other businesses and Snapchat? It shows advertisers are slowing down. The numbers were not good at Snapchat, and that is why this bullishness is probably over in the stock market. So we have a lot to talk about in a very short amount of time. Hit that like button and subscribe to the channel if you guys have not already. But let's get straight into it with the information. Snapchat down 25.5%, bringing down the S&P 500, bringing down everything with it, specifically Facebook, Pinterest, Google, stocks that do a lot of business in the advertising realm. They are getting crushed today, right now. That could be an understatement. They're getting absolutely destroyed, and it's going to affect the markets. It will. That's the bottom line to it. The stock market crash is back in play, and that is the new narrative. Yes, you heard it here first. This is much bigger than just Snapchat. So what is happening today and what happened with Snapchat earnings? So Snap shares plunge on disappointing second quarter results and plans to slow hiring. Snap missed on the top and bottom lines in its second quarter earnings report. The company authorized a stock repurchasing program of up to $500 million. Snap said it plans to substantially slow their rate of hiring as well as the rate of operating expense growth. So what they're saying is the situation is not good in the economy. And that's what they go on to say as well during the investor presentation, that really the second quarter deteriorated a lot faster than what they expected. Companies really pulled back, and they even mentioned TikTok yet again in that investor report, saying that TikTok is taking away some of their business. So when you boil this all down, this means consumer probably not so good, because when the consumer is spending money, when consumer is good, well, what does that do? Well, it makes companies go out and advertise more because there's more money flowing around. There's more people spending money. So that is a bad sign. And that directly feeds into, like I said, the other businesses, which are much larger, some of which over $1 trillion market cap, that will be affected just like Snapchat. So not good for the overall economy, not a good sign, not a good sign for a lot of these other stocks. Now, what do we have in store for us as far as earnings coming tomorrow? You have American Express, Verizon, Cliffs, Twitter, Next Era Energy. Long story short, companies that will not move the markets that much. But next week, that's where you have the holy grail of earnings season. I think Apple earnings are going to be terrible. I think Amazon earnings are going to be terrible. Google, Facebook, they're all going to be terrible, in my personal opinion, given the state of the consumer, of what we are seeing reported to us directly related to the consumer is, like I said, advertising. These earnings are not going to be good, and that will solidify new lows in the stock market. The only thing, and I mean the only thing, that could derail a stock market crash and actually send us higher from here is if the Fed comes out next week on Wednesday, they raise rates, they do their thing like we're expecting, but then Jerome Powell comes out and says, hey guys, we're going to stop raising rates as aggressively. We might actually just stop raising rates, period, for a couple of months to let families and businesses get accustomed with new higher rates. It might say something along the same lines of inflation starting to come down, commodities are starting to make their way, to the downside. Worst case scenario is all of these companies do very bad, which there's no secret there. They're all going to do bad. There's really no questioning that at this point. They're going to be terrible. Prepare yourself for that. They're going to be terrible. But the Fed comes out, raises rates, and they hammer down this aggressive, monetary policy regime that they're putting us in, aka they're not going to stop raising rates. And then you get the next day later, July 28th, and you get advanced estimates for Q2 GDP. Well, that's where you're going to get a flush out event. That's where you're going to get margin calls, and that's where you're going to see a lot of pain in the stock market in a very short amount of time. So it is confirmed, bottom is not in for the stock market. This is going to wreak havoc for many days to come until we get larger company earnings. So congratulations to everyone that did hit that trade. On another note, what is happening with the yield curve? The yield curve is still inverted 21 basis points. So that is the steepest yield curve inversion still since 1989. And we did have some other news today as well. President Young Biden tests positive for COVID-19 and he has mild symptoms. At the same time, you did get Europe, the ECB, it's like the Federal Reserve for America, but over in Europe, they did raise rates double what markets were expecting. Markets were expecting a 0.25% rate hike. They actually got a 0.5% rate hike, and the last time that happened was 2011, and the stock market did drop about 20% from the peak to the low during that time. And that was because Europe just has really bad timing when they raise rates and change policy. They really act too late, and they usually act when there's already a problem at hand in the economy. And that's what happened during this time. The ECB back here raised rates end of July. Well, what happened? I mean, take a look. Let's draw the trend line. All the way down, you dropped about 20% flat, and then you ended up actually finding a bottom. So with all of this information in mind, stay nimble, stay defensive, stay on your toes here. You know, the bullish rally is not here, and it will not be here to stay until the Fed does U-turn. The Fed is key. The fact that we're getting bad earnings is just not a good thing overall, but you know, it really all comes down to the Fed. If you would like to boil it down in one sentence, when the Fed U-turns, that is when you should start buying. Now, what do we have tomorrow for economic data? Well, we really don't have anything that's going to come in and save the day. You have S&P Global Manufacturing PMI. You have retail sales for Canada. Nothing that is really too crazy, so be mindful here. The Snapchat, you know, it's just going to clap the markets. Like, there's no other way to put it. It's going to clap the markets. Now, as far as what the markets are pricing in for next Wednesday, 5 days, 21 hours, 26 minutes away from now, what the Fed is going to raise rates at, well, about 72.1% of market expectations are that we will get a 75 basis point rate hike. You do have 27.9% of individuals, of investors expecting a 1% rate hike. So it's pretty clear to see that 1% rate hike is not going to happen. So it's not going to be anything too crazy once we get the Fed next week, 75 basis points. But the real question is how aggressive continuing to go forward. Is the Fed going to raise rates? That is the real question. So that is pretty much all for this video. Unfortunately, unless Snapchat comes out and says something crazy that we didn't expect, didn't hear about on their earnings call, maybe Snapchat Plus, the new, you know, subscription model they have, maybe something could come save the day. But at this point, get ready for pain in the stock market and new lows over the next couple of weeks. Again, congratulations to everyone that hit this trade. Kind of a shocker. I mean, how low some of these stocks are going, considering we are almost at the crash lows, the COVID crash lows that we seen for Snapchat. So that is going to be all for this video. Hit that like button and subscribe to the channel. Source your comments, questions, or concerns down below in the comment section. Thank you guys for tuning in, and I will see you in the next one.